It's like saving $30,000 without saving. If you remember from a previous chapter, I wrote about why the government did not give people a tax advantage for saving money. Well, I doubt if the bank ever will ask the government to do so because your savings are their liabilities. The US has a low saving rate simply because banks do not want your money or need your savings to do well. So this example is a way of playing bank and increase your saving without a great deals of effort. The cash flow from this $30,000 is reflected as follow. Income statement. Assets $30,000. There are several interesting things about the diagram. Number one, I determine the interest rate from my $30,000. Often it's 10% decrease. Most bank don't pay you more than 5% on your saving today. So even if I did use my own $10,000 as a down payment, which I try not to do, the interest on it is often better than the bank would pay me. Number two, it's like creating $20,000, $30,000, $10,000 down payment that did not exist before. Just like the bank does, it creates an asset and then charge interest on it. This $20,000 was created tax free. For the average person in the E quadrant, it would have taken nearly $40,000 for Vegas to be able to set aside $20,000. Income earned as an employee is a 50-50 position, with the government taking 50% before you ever see it through withholding. Number four, all property taxes, maintenance, and management fees are now the responsibility of the buyer because I sold the property to the buyer. Number five, and there is more, many great things can be done on the right side of the quadrant to create money from nothing just by paying the role of the bank. A transaction like this may take a week to a month or to put together. The question is, how long would it take for most people to earn an additional $40,000 so they can save $20,000 after running the gauntlet of taxes and other expenses incurred to earn that money? Income statement $40,000. Expenses, payroll, taxes, social security, balance sheet, assets, liabilities $20,000. The income stream is then sheltered. In Rich Dad Poor Dad, I briefly covered why the rich use corporation. Number one, assets protection. If you are rich, people trying to want to take what you have through legislation. It is called look for someone with deep pocket. The rich often don't own anything in their own names. Their assets are held in trust and corporation to protect them. Number two, income protection by passing the income stream from asset through your own corporation. Much of what is normally taken from you by the government can be sheltered. The harsh reality. If you are an employee, the sequence goes like this: earn, tax, spend. As an employee, you're earning a tax and taken through withholding even before you get your paycheck. So if your employee is paid $30,000 per year, by the time the government gets through with it, it's down to $15,000. With this $15,000, you must then pay your mortgage, but at least you get a tax deduction for the interest rate paid on your mortgage, which is how the bank convinces you to buy a bigger house. If you pass your income stream through a corporate entity first, this is what the pattern would look like. Earned spend tax. By passing the income stream from the $30,000 you invented first through a corporation, you can expend much of the earning before the government gets it. If you own the corporation, you make the rules as long as it conforms with the tax code. For example, if you make the rules, you can write into the bylaw of your company that childcare is part of your employment package. The company may pay $400 per month for a childcare out of a pre-tax dollar. If you pay for it with after tax dollar, you have to effectively earn close to $800 to pay for for that same childcare with childcare with after tax dollar. The list is long and the requirements are specific as to what an owner of a corporation can write off that an employee cannot. Even certain travel expenses can be returned off with pre-tax dollar as long as you can document that you conducted business on the trip. For example, you hold a board meeting. Just make sure you follow the rules. Even in retirement plans are different for owners and employees. In many instances, having said all of this, I want to stress that you must follow the regulation required to make these expenses detect deductible. I believe in taking advantage of the legal deduction allowed by the tax code, but I do not recommend breaking the law. Again, the key to begin Again, the key to being able to take advantage of some of these provisions is which quadrant you earned your income from. If all of your income is generated as an employee from a company that you do not own or control, there is little income or asset protection available to you. That's why I recommend that if you are an employee, keep your job but begin to spend time in the B or I quadrant. Your road to faster freedom is through those two quadrants to feel more financial secure. The secret is to operate in more than one quadrant. Free land. A few years ago, my wife and I wanted some property away from the maddening crowd. We got the urge to own some acreage with tall oak trees with a stream running through it. We also wanted privacy. We found a parcel with price of $75,000 for 20 acres. The seller was willing to take 10% down and carry the balance at 10% interest. It was a fair transaction. The problem was it violated the rule on debt that my rich dad had taught me, which was when when you take on debt. If you take on debt personally, make sure it is small. If you take on large debt, make sure someone else pay for it. My wife and I passed on the 75% pieces of land and went looking for a piece of land that make more sense. Piece of land that made more sense. To me, $75,000 is a lot of debt because our cash flow would have looked like this. Income interest, $75,000 mortgage. And remember my rich dad rule: if you take a debt and risk, then you should be paid.